Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Dave Erfle, founder and editor of the Junior Miner Junky. Now, Dave, we usually chat on Tuesday, but quite frankly, metal sector, a lot of markets pretty slow this week. And then on Friday, we had some geopolitical news that seemed to get the markets going initially a little bit more than the inflation data from Thursday and Friday. Seems like the big, I guess, winner we could say out of the geopolitics is gold to end the week, as that is up about 1.5% on the futures market. Gold right around 2050. Everything else, when you look at markets, those are relatively flat, little volatile today. Dave, what's your assessment this week of inflation data that was mixed? Some lower than estimates, some higher than estimates, and then geopolitics back on people's radar in a sense, especially in the gold market.
Yeah, I mean, coming into this week, we had the gold price correcting, that huge gain into the end of the year above $2,000 an ounce, consolidating those gains. Going into Thursday, which was the CPI release that everybody was waiting for, gold futures came down to test that area of support we talked about last week, the 2010, 2020 area. It got down to 2020. And then this morning, Friday morning, we had some attacks in the Red Sea, where that's been ratcheting up over there, causing a lot of supply chain issues, and that popped the gold price back over 2050 to end the week, going into a 3-day weekend above 2050 in gold futures. The gold stocks popped, also, and there was also PPI inflation data that came in cooler. So we had hotter than expected CPI data, followed by cooler than expected PPI data, and the futures market is pricing in about a 75% chance of a rate cut now in March, as opposed to the 70% chance coming in this week. But it was the geopolitical skirmish that is going on in the Red Sea is what really popped the gold price, and it hung on into the 3-day weekend. But the gold stocks, they gapped up, and they're selling off a bit as the stock market continues to ignore what's happening in the Middle East and ignore the reasons why the Fed is about to cut rates, even with their inflation target not even, with inflation not even close to their target at 2%. They came out in the middle of last month and issued this aggressive timeline of rate cuts, despite the inflation rate not even being close to their 2% target. So, investors continue to ignore the reasons why they're cutting rates. They just focus on the fact that they think the Fed is going to cut rates in March. As far as I'm concerned, I don't think the Fed is going to cut rates until they break something. I mean, that's their modus operandi, right? When it comes to rate cuts, they're reactive and not proactive. So they raise rates and they wait for something to break, and then they call an emergency meeting, and then they start cutting rates. I mean, that's what happened in 2001. In the very first trading day of 2001, Greenspan comes out after the dot-com bubble had burst, right before that. Greenspan comes out on the very first trading day of 2001 and announces a 50 basis point rate cut. And guess what? That was the spark that started the gold bull, 10-year gold bull market, which ended up going from $250 an ounce to $1,925 an ounce a decade later. I mean, this is what happens. This is what it takes for the gold stocks to finally take off, right? The economy rolling over, the stock market rolling over, and for investors to start looking for a hedge. Because even though the gold price is held up well because of all these central banks buying gold, the ETF outflows continue. Western investors, in particular, continue to sell their gold and put their proceeds into the stock market.
Well, Dave, I want to dive in a little bit further to the reasons why the Fed may cut, because everybody has been attributed it to, at least last year, they were all attributing it to economic weakness that was going to come in 2024. But we haven't seen any really indications of that in a major way when you look at the jobs data. But there is a big delta between where the Fed funds rate is at about 5.25 to 5.5 and where the 2-year is at 4.14 today on Friday, or the 10 years at 3.96. So you've got a pretty big spread between where the Fed funds rate is and where the actual bond yields are. And so Powell had kind of messaged that, hey, they want to bring that down. But they'd also, as you pointed out, mentioned over and over again that they wanted to make sure that inflation was down at 2% before they would start cutting. We're not there yet, and we haven't stayed there for a sustainable amount of time for sure. Is it that they think something bad's going to happen economically and that's why they want to cut? Or are they trying to narrow the spread between the Fed funds rate and where the bond market has moved interest rates?
Well, Fed Chair Jerome Powell basically told us. He came out at the beginning of December, right before that they announced that rate cut timeline on the dot plot. And he openly criticized the Biden administration, saying the government spending is unsustainable. Central banks, they rarely criticize governments in public. I mean, the last time the Fed openly defied the government was 1951 when they refused to purchase debt to prevent rate hikes because of the Korean War. But Powell carefully chose his remarks. They weren't a direct criticism of the government, but basically he issued a stark warning that highlights the most significant issues facing the economy, right? Which is simply out of the Fed's control, right? War, taxation, and government spending, the Fed doesn't have any control over. So he's basically telling the government, hey, you've got to get a hold of this, or something's going to break down the line because the economy cannot openly function for a long period of time with consistently high interest rates. And this is the reason why they came out with that dot plot timeline of rate cuts.
So, Dave, as much as we hear, especially in the metals community, that the Fed is reactive, the Fed's always playing from behind. Haven't they just outlined that they're trying to actually play ahead of things? If they do start cutting rates before something breaks, is that them being proactive then?
Well, putting out the time, I think it's political, because the government needs to have rates lower because now the interest payments alone are now $1 trillion a year, and they need to get rates down. So the Fed knows we're in an untenable environment with debt bubbles as far as the eye could see, straining under the pressure of higher interest rates. I mean, emergency lending by the Fed has basically bailed out these banks with this bank term funding program, right? So basically, they're extending and pretending. So, under the surface, the Fed is continuing to bail out these banks that are having these issues. But yes, I mean, announcing the timeline is proactive, but saying and doing are two different things, right? I mean, look, they announced this rate cut timeline, right? But what are Fed officials doing now after that timeline's been announced? They're jawboning hawkish. Mester and Bowman came out this week, and Gouldsby, all of them, they came out and said, look, rates are probably going to stay higher for longer, even after they announced that timeline. So the Fed's not going to, I don't think the Fed's going to cut unless they have to and they're forced to. And they're going to do it probably with an emergency meeting, just like they did in 2001, just like they did in 2020 because of what was going on with the pandemic. There's going to be something that happens because of their higher for longer interest rates, the highest interest rates in 22 years. Something's going to happen that forces them to cut rates.
Well, Dave, just circling back to the price charts for gold, you've made the case on our show probably more than anybody that we need to start seeing 2000 as a floor versus a ceiling. And while no one can declare victory yet, what we can say is this is probably one of the longest periods where gold has consistently stayed above 2000 and held it without quickly reversing back down, and put a lot of weekly charts up where you got to close over 2000. We're closing again this week over 2000. Is that encouraging to you that we are starting to build this proverbial floor? And do you think the market is starting to wake up and get more comfortable with a two handle instead of a one handle on gold?
It is, but we need that breakout above 2100. A monthly basis close above 2100 would get more people excited, and also the stock market rolling over to get people hedging. Because let's face it, I don't think investors are going to start to get excited with gold stocks, even though they're priced as if gold's $700 lower right now. They're not going to get excited in gold stocks until the stock market rolls over.
So, Dave, what are you watching in terms of the stocks then? Because there haven't been a ton of wins in the gold stocks. A few select names have continued to do well, but when you look at just how much the breadth extended at the end of last year for a wide range of other sectors, why isn't more of that money coming into gold stocks?
Yeah, it started to with Newmont starting to move higher on big volume, breaking a downtrend line, but then it reversed this week on lower volume, and it looks like it's going to close below $40, which was a key resistance line after being key support for a while, and now it's closed back below there, but the volume is really low. So we saw a lot of buying in Newmont with high volume, which told me that smart money was getting into gold stocks because that is the largest, most liquid gold stock. So, as far as gold stocks are concerned, though, there's still a lot of disinterest and the volumes are back to being low again. Like we discussed earlier, we need to get that gold price. We need a monthly gold price close above 2,100 to get the juices flowing in the gold sector again. I mean, I've never, gold stocks haven't been this cheap in relation to the price of gold in like 25 years. It's ridiculous. So, half of me is frustrated that the gold stocks have yet to catch up, yet to close that gap. But the other half of me is excited because it gives me the opportunity, and especially my subscribers and my new subscribers, to accumulate, a lot of these quality stocks that are trading at bargain basement prices and hold for the long term here. So it's excitement on one hand and frustration on the other. We always see, at the end of these bear markets, a turn, and it can happen quickly because this sector is so tiny. So, once you start seeing just a couple of large funds getting into the sector or big investors taking positions in some of these stocks, it starts to affect the whole sector and it takes off. We haven't seen that yet. We thought we saw the sparks of it at the end of December, but coming into this year, coming into the new year, it's an awful lot like 2016, right? We had the 6 months of base building in 2015, and then coming into 2016, we had a big sell-off, but it turned out to be basically a bear trap when the gold stocks reversed and just took off and never looked back after going up 200% after the GDX and GDXJ went up 200% in 2 months. That could happen again, or we could continue to lollygag around here. But if you take a look at the GDX and GDXJ, they've clearly made rounded accumulative bottoms. But we need to see more volume, and we need to see the GDX get above 33 and the GDXJ to get above 40 with strong volume to solidify that bottom.
Well, Dave, one more thing that may help GDX and GDXJ solidify the rounded bottom would be if we saw a good Q4 earnings report out of the mid-tiers, out of the larger producers, because what we can say about the end of last year in the fourth quarter is there was a pretty solid metals price most of the quarter. Yeah, it started off on a weak note in October, but November and December saw gold prices climbing nicely. So the average fourth quarter price should have been pretty solid for the mining companies as we've seen inflation continue to moderate and some would say come down in many key areas, maybe with the exception of wages. But if they can put in a solid fourth quarter earnings, and we'll just have to see how they come out, do you think that could start tripping the trigger for many generalists that would look at how these things are valued and what their PE ratios are versus things like the tech sector or like some of the other sectors running hot in the general equities? Do you think a solid Q4 earnings season may get more analysts and more generalists to raise their eyebrows?
I do, because profit margins are expected to improve now that inflation has pretty much leveled out and come down a lot. So we saw the all-in sustaining costs of the mining stocks average go up to $1,300 an ounce last quarter. I expect that to come down now that inflation has come down from such a high level earlier. And also BMO Research just came out and they're forecasting a decline in production costs of 14% for large miners and 11% for mid caps and 25% for small cap producers. So that makes sense to me because the inflation has come down so much.
Dave, back to your comment on this bear market. I find it interesting because, look, gold, when you go back to, let's say, the highs in August of 2020, 3 years ago, over 3 years ago, gold's right around the same level. But then you look at something like GDX and it's down 30, almost 40%. GDXJ is down almost 50% from those levels. Has something drastically changed in the market here where gold could do well on its own, but these gold stocks, maybe there's just more competition. Maybe there's just not the interest out there that these stocks just are looked at differently than just looking at the gold price?
Well, yeah, I mean, if you take a look at what's happened since then, right? The stock market's continued to climb, costs have continued to climb for these miners, and yet the gold price went sideways. So disinterest, general investment disinterest, speculator disinterest in the juniors as they continued to go lower because of the gold price going sideways and the costs associated with everything related to gold and silver going up. Drilling for it, exploring for it, producing it, especially capex on mining projects, everything skyrocketed while the gold price went sideways. I mean, that's a perfect environment for gold stocks to continue to go lower, and that's exactly what they did, and especially the juniors. But all that's done is create this incredible opportunity to take your time and get into the right stocks, get in a basket of the right stocks, and wait for the turn because we know it's going to happen. We just don't know when.
Well, Dave, one metal we haven't talked about in this discussion is silver, and it should be pointed out that if you pull up a 5-year chart, a 10-year chart, a 16-year chart, there is an incredibly tight correlation between what happens in the silver price and what happens in GDX. GDX is way more correlated to the lesser precious metal than it is gold. So it's always been the case that gold can make wild moves to the upside or downside, and the mining stocks may not necessarily follow. Now, eventually, gold is a prime mover and it will pull silver along. But let's talk about your outlook on silver for this year, because honestly, if we want to see GDX move, we got to see silver move.
Yeah, absolutely. I mean, you just take a look at what's been happening going into the new year, right? The mining stocks and silver both have been showing relative weakness to the gold price. They've been lagging gold, and that's been telling us that, hey, it's correction time. This is what happens, right? It's the miners and silver which generally telegraph what gold's going to do. And now gold is correcting, and the miners and silver telegraph this. So if you take a look at the silver price, I mean, it's less than $25 an ounce now. And in 1980, it ran up to $50 an ounce, and the CPI inflation adjusted all-time high of that would be $150 an ounce. It got up to $50 an ounce again in 2010, 2011 run up in the gold price, and yet now it's half that price, while the gold price is 2.5 times its 1980 price of $800 an ounce that it peaked at. So, if you want to look at silver stocks, man, if you think gold stocks are hated, if you think gold stocks are unloved, silver stocks are literally hated. Not only that, but there's only a handful of them that are worth investing in. So you got to pick the right ones. But if you pick the right basket of silver stocks and only one or two take off, it could really, really make a difference. This is what happened to me in the 2008 to 2011 run up, right? That my two biggest gainers were First Majestic and Silver Wheaton that I accumulated back in late 2008 when we had that spike low. And both of those stocks I had 20 plus bagger gains in. And sure, I did well in several other stocks, but just having a couple silver stocks in your portfolio, accumulating them at the right time at the bottom and holding on to them for a couple of years after they start taking off, they could really make a difference in your portfolio. And this is why this sector is so attractive right now, because there are more than a handful of stocks right now with that huge upside potential in them. And all it takes, if you accumulate a basket of 20 of them, like I have done for myself and my subscribers, all it takes is a couple of them to take off from here, and you'll do very, very well.
Well, I think that's what brings people into this sector. And for that matter, any sector that seems washed out is big gains. It's just the whole question of when those big gains will materialize, how long you need to wait in some of those positions, and quite frankly, hope that the stock price doesn't go down another 50+%. But I feel like we've talked about this for over a year now of just how unloved and underappreciated the precious metal stocks are, to especially where the gold price is. But I think everyone's just wondering what is going to change that. And hey, maybe it'll be this year, but we saw some of that economic data this week and didn't really seem to change too much of the outlook, but geopolitics has changed a little bit in terms of the gold price. But again, that's tough to invest on too. So, hey, Dave, thanks for joining us on this Friday. We'll see where we start off. I'm going to be very curious to see what follows through from the moves, especially in gold that we saw to end this week. Dave, thanks for your time. Have a great weekend.
You too, Corey.